black on the screen. So thank you so much, Michael, for the opportunity, and great previous panel. I think is a good opening. I think diversification is the key. I think we live in a world that going that fast, and that you have to be able to react and go back to the fundamentals. And the fundamentals are working capital. So working capital is what all the companies need. From the time they pay their supplier and collect from the client, they have this cash trap. And I have great panelists that I'm going to ask them to introduce themselves on different type of structures and different backgrounds. But at the end, they go, all of them kneel to the point and how we manage liquidity and how we make return and help the economy and companies to grow in a healthy way with a appropriate structure follow-up. And always, as in any investor, you have to be ready for default and collection. So this is a great panel that have expertise, not only on generating business return, but also on be able to build the right structure and collect. So I'm gonna let them to introduce themselves. We're gonna start with Eric.
Hi, thanks, Shalako. So yeah, Eric Wong here from TCG. We're a family office, originally a family office founded in 2003, which evolved into a niche asset manager and specialty advisor. The mandate from the beginning was to try to find some liquid uncorrelated investments to offset a more legacy, traditional family office type portfolio. Team of 20 globally across all three major time zones. Our aim is to really try to turn trades and traders into businesses. So what that means is really we're looking at working capital, book value driven trades, and how do we add enough value to turn those into more earnings multiple type businesses. What that means is that we're probably more like a trading platform, and debt is certainly one component of it, but we're not really purely lenders. And usually we try to treat the traders as partners rather than as borrowers.
Excellent. Deepak, you want to go?
Thanks, Shalako. So I'm Deepak Jogia, managing partner and co-founder of Highmore. We're an alternative asset management firm headquartered out of New York City, working with families and institutional investors to help them solve for capital growth, yield, and diversification. I head our trade finance business, as well as other specialty finance investing activities. We work with companies in the middle market and low middle market to help them release working capital through either accounts payable, their accounts receivable. We do purchase order financing, and we do floor plan financing. So we have multiple financing solutions. We do that in North America, but we also do it on a cross-border basis as well. Our approach is to work very strategically with companies. So while we're looking to generate a lowly correlated return for our investors and generate income in excess of what they can achieve in short-term corporate bonds, we definitely have a hybrid model with certain companies where we'll participate on the equity upside and help them both build and realize value, like Eric.
Excellent. Thank you so much. Sid, you want to jump in?
Hey guys, hey, thanks Shalako. Thanks, nice to see everybody here. So this is Asit Beeson, founder and CEO of Tuningbill. Tuningbill is basically a neo-banking digital ecosystem for cross-border importers and exporters, SME size. We provide banking services, the core to our business, which is providing them multi-currency accounts, FX and payments, and some other services such as logistics, etc. We do have a lending and asset management arm, and that's why I'm here. That arms lends to these SME importers and exporters on a trade-by-trade basis, pretty nifty stuff. And we tend to generate a really high return if you compare with short-dated fixed income, sovereign, semi-sovereign, or private debt. We'll talk more about it. We are just launching a new fund, $10 to $20 million, great return with various stratification, ability to invest at the senior, junior, or mezz level. Thank you very much.
Excellent. And last but not least, Jeffrey, you want to join us? I hope you park and not driving.
I am parked. Thank you.
Okay. Excellent.
Yeah, this is Jeffrey Marin. I'm the founder, CEO of Sheridan Capital. We've been in business 20 years. We've done approximately 150 transactions. We specialize in specialty finance. We focus on lending senior capital to specialty finance companies. It could be consumer, commercial, esoteric in nature. The second sleeve is we finance and acquire distressed assets. We'll finance distressed debt buyers in a number of different specialty finance verticals. The third piece is we find interesting origination businesses to grow and buy assets. And the fourth sleeve is we have a business of buying distressed loans, leases, receivables, and assets. Along with that, Sheridan also has 3 collection operation opportunities that we have helped build, and gives us an interesting perspective on how to value servicing, processing servicing, and how to value assets going from exit strategy to the front of the acquisition channel. So thank you, and look forward to participating in the panel.
No, thank you all. The first I would like to start is like a view, all of you in the industry of working capital and related to trade finance. We see that with COVID, there is a big impact on supply chain, and I'm saying supply chain financing, but on supply chain, we see how the world struggled to get raw material from one point to another, and now liquidity and cash availability is critical as suppliers are getting more leverage than buyers because all these logistic issues that we have to suffer to COVID. So today, in order to get the right product, the right raw material on time, in order to serve your customer base is more critical, and that cash that is trapped in the full cycle that could last 120 days is around. So I feel my feeling and listen to the other panels, it's going to be great years ahead of us for everyone that is willing to invest in trade finance and supply chain finance, just because there is all this cash trapped in the cycle, and then we have this opportunity to grow. So I was told, Deepak, what is your vision of our industry, the market, and even though we had some noises recently with one large company on this sector, but there was not really related to supply chain financing. So how you see the future of what we're all doing?
Look, I think trade finance and supply chain finance over the last 2 weeks has really been in the press. But obviously, I think you probably expect all of us here to be talking our business lines and opportunity sets. But I think it's important to take a step back, because when you think about it from the investor standpoint, the people who fund us, they need to generate a yield when you have this compression across all sectors of fixed income. On the other side of it, you have companies, real economy businesses, whether they're manufacturing businesses, industrial companies, business services, and they need to operate. And Shalaka, you always talk about this, whether you're in an upswing or you're in a downturn, you still need to pay your suppliers and you need to collect from your buyers. And it always comes back to that point. And I think sometimes it gets lost with investors that what we do as a collective group in our universe is we're very much engaged with companies on a granular basis. We're trying to help them unlock capital from either their payables or their receivables. I mean, they need money either for 2 things. One, it's a strategic initiative that's going to be a step change in their business for growth, or it's an existing business that's received a large volume of purchase orders, or they're going to be pending pretty soon, and they need to come up with the capital, and they really need the speed and certainty of execution, and really having a partner in place who can solve for that. So for us, what we do is very evergreen. what we've seen, and it'd be great to get the input from the other panelists. We have seen banks step away, certainly over the course of the last 12 months. That may change. That's probably likely going to change with the amount of Fed liquidity that's been injected. We've certainly seen credit-worthy businesses, particularly traders in the commodity space, who've been turned away from banks or have been told to wind down lines and transition. So I think from that standpoint, the opportunity set expands as certain funders become more prone to retrench than support businesses.
And that's a great segue, I would say, for Asid. How do you see neobanks fit into working capital and solution for the SME? I think large corporation, they always had access to this type of structure, but where is the major need right now is middle market, small companies. So how are neobanking fit on it?
That's actually a great point. So I think Deepak already slightly touched on 2 points about how banks have pulled out. Not only banks, even insurers have pulled out. So insurance pulls out, the funder pulls out, and that has been a big headache. And we are talking about the SME market. They were doing factoring. Suddenly, the factoring insurer pulled out. What do you do? Where do you go? Now you cannot get your working capital funded anywhere. We are really sitting at the tactical end of the spectrum. We are not into the strategic market. And at the tactical end, things move fast because we are serving traders. They are very nimble. They decide what is selling in the market, what should sell in the market, and they want to make a very quick decision. So what the neobanking does is we figured out that the core of the problem is actually the visibility of the data, including the financial data. So we started with the solution of neobanking, which gives us the ability to see how the cash is moving at very micro level. And that brings us nearer to the business. And hence we are able to make a much better decision about whether there is, putting aside all the fraud elements, if this is being used for the right purpose or not. And since you're trading, you are funding a trade, you know that the goods are there to be sold. They're already finished product. So the downside risk is about not being able to sell. What we saw, on the other hand, is during COVID, that our demands or the demands from our customers grew because suddenly things are moving towards e-commerce, SMEs are selling online, the stores are shut down, and the banks have suddenly pulled out. And that's where we step in. And this is the beauty of digital banking. We have the full visibility of, we are stepping in at the right time. And we are also in slightly niche market. We are into importer, exporter, cross-border market, which is regulation-wise the most difficult one to crack, but technology solves it. We are talking about tens of trillions of global trade, and that's where we are stepping in quite a lot of underfunded businesses, as you can imagine.
Thank you, Sid. Eric, I want to jump in on you as an investor and participate in this program. So where in the capital structure and supply chain do you operate and how you enter in this ecosystem?
Sure. So we're almost exclusively focused on the equity tranche. So the lowest or highest or lowest, depending on how you see the cap table and so on. But we're focused on the equity tranche. What we find is that there is a decent abundance of senior debt, a little less mezz debt, but on the sort of co-investment at the equity level, we usually do structure it as debt or it sits on our own vehicles. So like I said, we're more of a platform rather than just a lender. But ultimately, we are sitting with the trader usually, and there we find there's a lot less sort of competition, so to speak. And usually, what we're doing in that process is that we're funding pre-export, pre-invoice type of segments. So very early on, and usually there is still an anchor tier one corporate on the paying side. But for some reason, idiosyncratic to the subsector or this particular borrower, there's a supply chain that stretches into a situation where there must be prepayments. For example, we're active in used cooking oil from China going to Europe for biodiesel. Now, that trade is a mom and pop very broad, sort of a reverse funnel, if you will, where there's a very broad base and there's a very tight vertical concentration of the buying power among large corporates. So what that means is that you have all these idiosyncratic mom and pop situations where they don't have the capital, and usually in the process of collecting, it's a cash and carry business. So no one has really, it's all driven by working capital, and it's driven by prepayments, of which the large corporates would never do. So we step in, we get the local custody of the product. We're usually at the site, weighing the trucks as they come in and out, testing the product, and we get to charge something for that trouble. It's sort of work intensive, but margins are attractive. So that's where we choose to be. And we don't really we'd rather be focused on certain areas rather than diversifying extensively. So, we think that sometimes diversification is a little overrated, but sort of domain expertise, controlling collateral, process, those are somewhat underrated relative to the most people look at a rating or something like that, and then that satisfies them. So in more bespoke trades, that may not be an option, and you just have to do the work.
Yes, and it's interesting in our industry, different to other assets. I would say we're less impacted by cycles because we're short-term financing, and everyone has to trade. Everyone has to buy and sell to survive.
Rates go up. That's even good for us. Yeah,
and I would say the major challenge for all of us, and I think the Jeffrey expertise on that, and I think we all have it, is how to get in and get out fast, and how to collect and do the workout experience from the day one is critical. And understand that certain sectors we need to step out and jump another, and that's the beauty of working capital, that we don't have to focus on one sector because everyone has to purchase and sell. But I think the workout strategy doing day one, and Jeffrey, if you can talk a little about that, because I know that you have a lot of expertise on this, it's more critical because fraud happen and you need to be ready for react. So Jeffrey.
Thank you. Yeah, I think as all participants in the ecosystem, the players that last in these spaces are players that understand that on the first tee you need to price the purchase or financing of that asset with an exit strategy. And if it's asset based and it's collateral based, there's inventory, there's finished inventory, there's everything from trucks and real estate and equipment, and then there's IP, and there's the liquidity of the corporate side of the balance sheet. Is there access to liquidity for that space? So all these different things, you might think you have collateral, but that collateral doesn't have any value because correlations go to one when there's a gap in. So if you are specific to an industry or a sector or a business type, one must be cognizant of and acknowledge that we've got to have a handle day one when we purchase or finance that asset. What's the exit strategy? What's the timeline? What are the expenses to take it down that timeline? And what are my recoveries? And as I said, my recoveries can be through collateral, or they can be through liquidity with enterprise value of the company. Those things are important for investors to examine. And one of the most important things is talk to, as an investor, if you're talking to experienced managers like these, you want to make sure, have they had an experience set? Have they done it before? Have they done it in a specific sovereign jurisdiction? Have they foreclosed? Do they understand the perfection issues? All these things matter, and they look through for you, or the transparency, look at their experience set. Make sure that they've participated in credits that not necessarily have gone well. We had a conversation pre this call, and all of us laughed at when you talk to somebody who said they've never had a default, they never lost any money. I am of the mind when we lend money to entities or SPVs or whatever they are, it's nice to see that people have past experiences
You want to jump in, Deepak?
Yeah, sure. I mean, I think there is no, as they say in finance in America, there's no free lunch. So when you think about the types of transactions that we do, very understandable because they're real economy businesses, but there's a relative value spread that we may pick up on a credit. Because, give you an example, we do a transaction, it's discounting receivables, fully notified, and one of the debtors is Chubb Insurance, and we make on a gross basis about 15% yield on that transaction. And when you look at Chubb's 5-year paper, it generates sub 1% yield. So there's clearly a excess spread that we're earning on Chubb credit risk. But ultimately, when we think about this, why do we earn that? Well, there's the illiquidity piece of this, but then there's the operational risk of this, of working with the company that's a mid-sized business, and they need that discounting to occur to release that working capital. But then you're managing just the operational risk of that relationship. There's certainly fraud risk that you have to think about. In this instance, it is, I never like to say it's zero, because nothing is ever zero, but it's, we certainly have that managed. So looking at these transactions, I think investors thinking that you can earn a high yield with very low risk, that's really just not the case. We get paid for that complexity risk, and as Jeffrey was saying there, to work deals out. I think just topically, over the last couple of weeks, with what people have heard about Greensill out there, they had a strategy that was almost completely dependent on credit insurance. And when that is your only exit, that's not the most effective strategy at the end of the day. Financing transactions, they have to stand up on their own 2 feet. Credit insurance is a security blanket that you use. It's not the first lever that you pull.
Totally agree, and probably me being a banker, more conservative, I never relied on insurance as a source of repayment. It's just a mitigation or something that help, and it's an extra eyes on the plate, because insurance, they do the underwriting, so that help to know. But I think as we do in the banking industry, you need to know your customer, you need to know the product, you need to know the industry, who's buying, who's paying. You need to understand the full cycle, and something key that a lot of investors and a lot of we only focus on yield, but is character, and this is in the industry has been missing that. Where is the character of your partner? Because you're helping those companies to grow and develop their business, but you need to have transparency and see where are the area of risk in their industry. So how do you structure a deal and return on that? Because I don't see a default risk unless there is a poor structure, but I see more like a cash management and return on the structure and the operation that you have. So I don't know, Asid, you want to jump in a little bit, how you structure and what is the return you're seeing and the follow-up?
Yeah. So basically, the structuring, there are 2 aspects to it. One is you look at the structure of the trade, taking into account the SME itself, like how they're structuring their own business, i.e., how much is their skin in the game in the business they're doing. That I look at it, or we look at it as the actual equity portion of the business. So in a business, if they have, let's say, 30% skin in the game, these are SMEs, small businesses, that means they themselves are putting their own kind of risk as the first loss, and then we step in. So when we look at, and I'll tie in the fraud aspect to this whole angle as well. So I look at fraud as we look at the 2 places where fraud can happen. One is at the company level, and the other is at the structuring level as well, that we are doing. Fine, we are setting up an SPV, things grow bigger, and how the SPV is structured, there can be some operational mistakes, structuring mistakes, and to some extent, intellectual fraud, I would say, like, oh, you can do it, this structure, and that makes it safe, including this insurance or, or that tranche, etc. Now, once you understand the business, how it is structured, that gives you much better understanding of how you want to structure your SPV, where you're taking the investment. So the two has to work in sync. And that's the most important thing that we are relying on. So when we look at the total investment from the end investor, we are looking at what are their risk exposure, not purely from the SPV perspective, but also from business to business perspective. Is each business able to withstand a little bit of equity shock in the market, like COVID happened? Could they still manage to keep their business afloat? If they cannot stand, there will be a cataclysmic effect, or kind of like one after the other, things will start falling down. And any trigger, if every aspect has to have the ability to absorb the shocks, either it's the business itself or even the SPV or the funding vehicle. Yeah. If each of them can take a little bit of shock, then the whole thing will stand and not collapse. So that's the way we are looking at the businesses.
Yeah, and that's very interesting when I see Eric model that he put some equity on this company, and
exactly
having that vision, like it's a little different that we all do, and it's very interesting. So Eric, how you come out to that structure, and what you see the advantage to have part of equity on those company and support the trade business?
Yeah, so this kind of, because we started out from the listed exchange traded instruments side, because there's a preponderance of options market makers in our firm, even though not all of them are trading options, and we converted some of them into getting into the physical side of the world, physical commodities, etc., niche ones. So in the financial side of things, you have managed accounts. So you control the account and you delegate someone to put trades in there, and you can control the book. You own every asset. There's no way they can run away with the money. You can end the trade and the relationship with the trader at any point in time, should you so choose. So the question for us was, that seemed to work okay in removing some amount of fraud. How do we bring this to the world of physical trading, or physical, digital, whatever you want to call it? So we ended up, we actually started out in the telecom industry, and there we built up our own switch infrastructure. We got licensed as a telecom carrier, and then we started talking to other telecom participants who needed financing. We said, well, okay, we're up for doing this, and we're certainly happy to put up the equity alongside yours, but it has to go through a structure we control. So the aim was to eliminate the fraud, but it also had this flip side angle that when I talked to, the funny thing is when I talked to a lot of the lenders, when they look at their best borrowers over a longer period of time, almost all of them wish they had equity in those borrowers rather than just lending money. They're very consistent. After 5-10 years of this person repeatedly paying you a yield that is quite attractive, they must be doing something right, that they're still in the business and they're doing quite well. So part of it was also the idea of, this is our comfort zone and our way of doing private equity. We're not comfortable giving money like a VC to people to burn and, spend it all and hopefully it turns into a business. We're driven more by, book value driven operations, but out of that might come, a VTOL, a Trafigura, something like that, that has a small beginning. So we'd like to get in on the ground floor. We just have to pick your battles. You're not going to go try to build another Trafigura now. You'd have to pick like another niche area. And so that's the thought of trying to bring some sort of hybrid structure into this, and certainly participating in the equity.
That's very interesting. And I'm going to challenge Jeffrey. What would be the 3 questions that an investor should ask a manager when they're making an investment decision in our sector? So
I think I really touched on it, and I think you did a good job starting out talking about fundamentals. Is one, look at the track record, but don't look at the track record on a cursory basis. In your diligence, find out the transactions that didn't go well and how did they mitigate downside exposure. because all the conversations we all have are theoretical, right? You want people, professionals, you want counterparties that have gone through cycles and have experience and have shown that they know how to mitigate downside exposure. That's job number one. Job number two is, do they have the resources at their firm that you know they're going to be in business during the period of time your capital is going to be outlaid? Because there's a lot of capital formation going on, and there's a lot of small to mid-sized groups that you want to make sure that they're well capitalized, because you're basically taking operating risk with them. That's part of the credit risk that you're taking, is who's managing those assets, and are they going to be there to manage those assets through the life of what your exposure is. That's two. And three, make sure you do background checks, and make sure those background checks are tied to the resumes of each individual principal, so that you can match off the timing and the information, so you know there's no holes. Because once you are in a transaction or a fund or a vehicle with somebody, you are in. And that's when the work really begins. So you want to make sure on the first tee that you're dealing with people of character. And I think it's already been mentioned and shouldn't be minimized, that a good manager can get you out of a bad situation. And that is, out of 20 years of doing this and 150 or so transactions, a good manager will get you out of a bad situation. And I will tell you that is critical, critical, critical.
Awesome, excellent. Just a little bit, how's your relationship with investors, Deepak, when you go out and then to the others? What is kind of the approach, or what are the questions they ask the investor when they participate in these structures?
So I always view, and my view on this has changed just based on experience, is, investors are going to become partners with us. It's almost irrelevant of what size they are. And I think a lot of managers think about, so I'm going to treat someone who gives me 25 million different to someone who's going to give me 1 million, but that really shouldn't be the case. And that's something I'd impress upon the investors, that the way you get treated, you can tell are you getting the treatment that you really deserve. So that's really the number one point. But it's very much a two-way process. For us, we make our own assessment of the investors too. And the things, some investors come in and they're doing what I'd call very cursory work. And we've had this with, frankly, very storied credit firms wanting to work with us. They like the profile of what we do, but they don't really want to get into the nuts and bolts of our strategy. And for us, someone who likes the high-level profile of the deals, but doesn't really understanding all the operations and the risks around that, we've turned those types of relationships away. We have other clients who have really worked with us, and they think about it not as allocators but as principal investors. And it's almost like when you play tennis against the world number one, even if you're not the best player, you really raise your game versus playing somebody else. And I think those are the partnerships that we really look to build. It's not just a kick in the tires, but it's very much a partnership. Someone who's going to be there for the long term, someone who goes in really eyes wide open to the risks out there.
I'm sorry, this is just Jeff. I just want to say you're spot on there, that we as a manager take, and depending if it's a commingled vehicle or if it's a SMA, but you're taking counterparty risk. And it's very well said that you want to, as managers, and if there's managers on the call, it's always easy to just take capital, but you want to take capital that understands what you're doing. I think it was very well said. And because that brings risk to the transaction on its face also. So I just wanted to say, hey, I thought it was a great point, and you're totally spot on.
Yeah, and I think that's kind of Eric's point that he jumped in, that understand where you're investing, and that's why you enter in equities. You say, okay, this is a good business, well handled, I can get the good return, so why not to invest? That's type of the discussion that you have with your investor, Eric.
Yeah, so I mean, for us, it's only recently that we started having conversations with external investors. Up until now, it's really all been internal capital that we were deploying and trying to figure out a solution for finding liquid, uncorrelated strategies around the world. But one thing we did do was that we actually were investors in several of the trade finance funds back in the 2000, like actually between 2011 and like 2018, we ourselves were investors. And one thing we did notice towards the recent years was that they had a couple of quality of underwriting aside, which is of course the most important thing. But even if you put that aside, there were still some issues with the structure of how people set some of these up. Most of these guys started as basically they stuffed a short-term lending strategy into a hedge fund type liquidity profile. So it's like quarterly, 90 days, et cetera type stuff. And their loans theoretically were short-term, but it never quite works out like that, especially in a COVID scenario. Things get stretched out, debt moratoriums, all that kind of stuff. So really the true liquidity, there was an asset liability mismatch, and in some cases, a fairly substantial one. The second thing was that because they were sort of in this hedge fund open-ended structure, the yield was never paid out. And most of the investors never bothered to redeem out the yield, even though that's what got them in the first place. They wanted the yield, but they never collected on the yield. They just kind of let it compound, which added to a cash drag problem for a lot of these managers who then didn't want to give the money back, and then that's when you start getting into problems. Then they started getting into longer and longer term loans, which totally blew away the asset liability matching, and or just sloppy underwriting on the same conditions and terms, both of which are deadly. Or just the cash drag alone just brings down the yield to a level that you really only possibly Japanese investors might be interested in looking at your fund at that point. Another thing was also, once they build up books of like 150, 200 loans or something, I don't think even the manager could follow that in that kind of format. And forget about giving transparency to the investor. Like, if the manager doesn't even know, how could the investor even be given the correct transparency? And we're based in Hong Kong, so we're a non-US investor, though we do quite a lot in the US. The fourth thing that we found that was most interesting was that, a lot of these guys started going into sub-Saharan Africa, Latin America, all the emerging markets, and they should. There are interesting opportunities there, but they could not offer us as foreigners a way to access the US, which is like, you want certain types of yields, like there is no bigger market. So you're pushing the limits of jurisdictions that you can enforce on collateral and things like that, when there is the US right there. But because of tax complexities and the fact that direct lending is a state regulated activity in the US, I rarely see foreign investors having an appropriate vehicle to go into the US. I see season and sell. We think that's an aggressive tax strategy, though it's not really been challenged. But the tax, you shift all your efforts to like making sure you don't fall afoul of the authorities in the US, especially the tax authorities, as a foreigner. So those were some of the things we noticed with some of the other funds. It's probably still an issue lying out there.
Yeah, that's interesting. And I would like to jump. I see it on the cross border. I know you deal a lot with correspondent banking and cross borders. So tell us a little bit about what you're doing on cross border risk.
Well, it's a very simple reason, and the obvious one. It's a regulated trading environment, unlike domestic. As I think at some point in time Deepak said, there is no free lunch. So we kind of are generating return for regulatory arbitrage, and regulatory arbitrage in both moving the money and moving the goods. We simplify and we solve these two problems with banking regulations as the underlying solution. And it generates extra return for us. Same trade, if it was domestic, it will be much lower return, pretty secure, you would say, and various angles, including the fraud risk, are much lesser in the domestic market compared to the cross-border market. And that's the aspect. That's where we are kind of operationally using digital aspects, neobanking solutions. We are kind of generating much higher return. But I'd like to touch on a couple of points on your previous questions regarding the investors' confidence in your investment strategy, and that's very important. I think two key things we kind of offer to our investors, and I think that kind of encompasses most of the things. The first is, obviously, you're talking about risk. You have to explain them the risk very transparently. And if you co-invest with your investors, that technically takes care of many other aspects of, have you looked through the deal? Do you understand the business you're investing in, blah, blah. So if we are the co-investor, and especially if we are the first loss taker as a co-investor and as a manager, that sorts out many of these problems. And the second thing, I think Jeffrey keeps mentioning that, and that's very important, is what is the worst case scenario? What's the tail risk? You cannot say to your investor that you will never lose money. What you have to tell them is under what circumstance you will lose the money. What's the worst case scenario for you? So long these two things are laid out on the table, we have the skin in the game, we are the co-investor, and we know together under what circumstances first I get wiped out and only then it affects you, that takes care of the investment strategy.
That's excellent. I don't know, Jeffrey, you wanted to jump in on adding something on this?
Yeah, the point before, as far as access to U.S. markets and season and sell and trader business, I agree. Another great panelist, I totally agree. I think it's an aggressive form, but it's been a form that's been used. And outside of this panel, I'd love to have a conversation with you about it. I have some ideas, but I just think it was very relevant, and another relevant point by a panelist here. I mean, I thought it was very value added.
Well, I think being a banker in the US for almost 20 years, initially I focused on trade financing internationally, and little I moved to domestic side. I think the knowledge of working capital solution, turn around the cash and free that cash, is still I would say baby step in the US. I think it's more practice in Europe and Latam and Asia, and now all these factoring, supply chain, and there is so many terminology, but at the end it's something simple. It's how we turn around from the time we pay the suppliers, transferring inventory and sell it, how we get free of that cash, and the concept is getting to the table. So I think, Eric, and the opportunities you mentioned, well, this is the largest country on consumption. It's even still with COVID, the country continued to consume, not at the same level, but imagine the rest of the world impact that we haven't seen yet. How deep COVID going to impact the rest of the world? We feel it very strongly here in the US, and now it seems to recover it to the point that everyone is shaving, and except me. So I still have my COVID beard. So I'm probably gonna need to start shaving back again. That means good news, I think. So yeah, this is a huge market, a huge opportunity, and I think working capital, more of us go out and explain all this structure, explain how we work, how we collect, how we work in the worst case scenario, as Jeffrey mentioned. This is an asset class that right now I get a lot of attraction, even like this is an alternative finance forum, and I'm the only banker in a way. I see a lot of investors want to look at it because here, at the difference with other kind of assets, is self-liquidating, is short-term, and if you have the right manager, you know where you're financing and what's going to be your return. So I don't know if any of you have the same view and want to jump in on this.
So I can jump in, being an ex-banker, Shalako. And interestingly, my last company was Credit Suisse, pretty well embroiled in with Greensill. So,
yeah.
So I was just chatting with the guys who were involved into this, actually, which is interesting. It's purely from the perspective of insurance and all those things. Now, insurance, it's a matter of scale. If you are operating at 1 billion, 2 billion, 6 billion kind of lending book, it's a different ball game. I don't know, how do you call it, a working capital solution game, right? And you are right. We are talking about a portfolio. If we can pass the acid test of a working capital solution or portfolio, which can self-unwind, can your book unwind by itself if we stop lending more? Because typically what happens is, we say it's a short-dated investment, but think about it. The guys are actually rotating invoices after invoices after invoices. They are in the process of rotating. The business doesn't look at it as a 1 month, 2 months, 3 month solution. They look at it as a short-dated solution for a long-term problem, right? And that's exactly what we saw during the COVID time. Invoices that were funded for 2 months were extended by another 15 days, and then by another month. Now, do you pull out? Now, what can force you to pull out? If you were backed by an insurance and the insurance pull out, you will be forced to pull out. Your covenants kick in, and there's a default.
Yeah, I'm not going to share my secret sauce, but pretty much, and I've been doing this for a while, pretty much you need to monitor very closely all your corporation, and you did that. Yeah. And you need to make them understand that what is on that liquidity that you free, what is there is only their margin, because at the end you're going to have to pay the supplier and collect from the client. So exactly. I hate, and again, I have a lawyer background, so that get me some time out of trouble. Covenants, when they hit, is too late. So I rather work with trigger and see the storm coming. And you need to unplug. I always say, in this kind of business, when you're in short-term financing, you see the storm coming faster than anyone else. It's always like when companies stop paying their leases, or stay paying the mortgages, or restructure the syndicated loans or the long-term loan, you react too late. The advantage when you structure it properly, you know what they're buying from their supplier, and you see that going down, or you see how the sales goes. So you have the vision of where is the issue coming, where the construction go down. So you need to step back and sit down with the company and understand that challenge is how you gonna support, but also you need to step back. I think that the major issue in our industry is when you get greedy, and as you mentioned, you turn around and you turn around. Oh, I'm making money, I'm printing dollars, but you never stop and breathe and say, okay, why this is working that way? Where the monies go? And I think that's the major issue in our industry. And recently happened the issue with Greensill, but I always explain to the bank, it happened to real estate. It wasn't a crisis of real estate. It was that the financial market was getting greedy and making so much money on real estate that we created a bubble, in a way, all of us, from the construction to the buyer, and the fundamentals were not there. There were people that didn't have the income and they have 3 houses. So again, I agree with you that you can get greedy and comfortable in the process. Yeah, but you never, as a manager, and Jeffrey mentioned it very well, as a manager, you need to work with the right people, ready for the exit, and take the exit. In the financial business, you need to know how to step in and how to step out. And I don't know if Deepak, do you want to jump in on something like that?
Sorry, just unmuting myself. Okay, I think that's exactly one of the points you made there, subtle but hugely important, is monitoring the positions and build beyond just understanding it on the way in, living and breathing it real time. I mean, companies ask us when we're going through due diligence on them, they've said to us, do you want to get into our business and start a business? Because just the granularity of the questions that we ask them. And we said, look, the better we know your business, the more stable a situation you'll have from a funding standpoint. Because look, there'll be benign environments and less benign environments, and working with companies through that is really important.
We have 5 minutes, so I don't know if you want to give some final word. Maybe start with you, Eric.
Yeah, that I think we covered the topic pretty. The only thing I was going to add was that and this is probably also something that all the other panelists have some experience with, is that to go deeper into when stuff hits the fan, which has happened or is going to happen even more, is one thing we learned was the cross-border, when you're dealing with the cross-border multi-jurisdiction nature of things and what sort of tradecraft you employ to try to protect your position. The cross-border thing, if played well, is potentially an advantage. An example would be that we try to use a two-pronged approach where, and this is not necessarily against the trader, but possibly against the trader's counterparty, where we have a local entity that can seize collateral immediately and is probably charging a sort of a low interest. Certainly in many countries in Europe, for example, there's usury rates that cap off what you can do. So in the case of, you're charging let's say a reasonable interest but you're local and you're able to move on the collateral as quickly as possible. At the same time, we usually park another entity, possibly using US law, to go on as a service provider of some type and thereby avoid the usury rate limits, and to be able to continually penalize that and to possibly get other types of slower but more punitive measures to be applied in the case of recalcitrant debtors and so on. But so that sort of tradecraft was something that we learned the hard way, and it comes out quite starkly when it's a cross-border scenario. So that was the only thing I was going to add to the discussion.
Excellent. Asid, final words?
Yeah, I'll just add, look at it as it's the tactical solution for any business. We are talking about working capital solution. We are the first to see when things go wrong. It's because we are serving the short-term solutions, and hence it's the most nimble investment for any investor. And given the current scenario or the current interest rate that you are getting in the other markets, trade market, these asset classes are the best still. There's no doubt for this duration class.
Jeffrey, any advice?
Just
final word.
Diversification doesn't just mean diversity by counterparty. It means diversity by what your exit strategy is, whether it's collateral, whether it's corporate guarantees. In insurance land, you can have a surety, you can have credit insurance, you can have a monoline wrap, and you better understand the fine print. So my advice in any of these is be diversified in what supports your collateral value, that supports your downside exposure in any one of these opportunities.
Excellent. Thank you. Deepak?
No, I think it's it's thinking about these deals from the standpoint of not just the yield, but I think being integrated with the companies, having really strong monitoring, and thinking about the multiple ways that you exit out of these transactions.
Excellent. Thank you. Well, I want to thank you all. I think
thank you.
We are done for this panel. I don't know, Michael, want to jump